Hi, student. So for this video, we're gonna go over two questions about investment. First, I'm gonna show you an example using debt investment and to showcase how to do fair value method. And the second example is we're gonna use equity investment, but it's going to be an equity method, okay? Here, I will really emphasize where you should pay attention in doing question like this. So first, take a look at the question number one. Question number one, this company, they bought a bond investment. Here, this bond investment, they only pay interest once per year. Therefore, like when you do question like this, always pay attention how many times they compound in a year, because that's how you calculate the present value of this investment. And the company uses effective interest method, which means when you create an amortization table, we are going to amortize by using the market rate. And this security was classified as available for sale. This is super important for debt investment. Remember, if you use a held to maturity, and then you do not use fair value method. If you're going to use fair value method, for the end of year adjustment, it must be available for sale or trading. The difference between available for sale or trading is when you use unrealized gains and losses. For available for sale, it will be dash equity, which means this goes to other comprehensive income. For trading, it's going to be dash income, which means this unrealized gains and losses will show up on the income statement. Okay. And this also tells you the fair value of the bond at the end of each year. We need to use this number for our fair value method adjustment. So here it tells you 2017, 2018, 2020, and 2021. Okay, so let's take a look at this question. This question asks you three things. First, what's the journal entry at the date of bond purchase? To do journal entry like this, we need to know how much the company actually paid for this investment. Or in other way, basically said, we want to know what is the present value of this bond investment. Here, we needed to create an amortization table. So for the amortization table, the first is date of the purchase. So that will be January 1st, 2017. Okay. Here, the first thing you need to figure out is what is the present value of this bond. To figure out the present value of this bond, you can use the Excel financial calculator or the table. I will have another video on how to using the time value money table to calculate present value. But for this question, I'm just going to use Excel. Yeah. So the Excel you're gonna use is you just put the equal sign here, and which will lead to the formula called the present value formula, or PV. Okay. So you can just click on this little formula sign on the top, and the rate here, very important, it must be the market rate. So what is the market rate? Market rate is how much the market is willing to assign you the cost of the debt if you are issuing the debt. So here, market rate, also called yield, which is decided by the issuer's risk. And in this case, it's 10%, 10%. Okay, so based on how risky the bond issuer is, and the investor are willing to pay 10%, 10% for the yield. And here, how many periods for 2017 to 2021? Because they compound once per year, so the period is 5. It's 5. Okay, so if you're not sure, you can actually take out your finger to count. Just remember, the last payment is on January 1st, 2022. So if you count the years in between, it's actually 5 years. So the payment here, we refer to the cash payment. And how much the company receive as a cash investment is decided by using the stated rate, that is 12% multiplied by the face value, 300,000. And so 12% multiplied by 300,000, which is equal to 36,000. Okay. Future value here, you expected to get $300,000 back. Okay. We just leave the type as blank because this is an ordinary annuity due for the interest payment, which means you receive the interest at the end of the period, and therefore by default we don't need to put anything here, and we just click on say done. And you can see here it gives you a elective number. It's just because the direction will assume whatever you're going to receive in the future is positive. Therefore, whatever you have paid out is elective. But for amortization purpose, we do want to see this number as a positive number. So I just put a negative sign before this formula. Okay. All right. So that's how we get the present value for this bond investment. And that help us to set up the journal entry. So the journal entry on this date, on January 1st, 2017, it's just going to be cash. You paid out this amount, credit, and we call it the debt investment or bond investment. That's the amount you're gonna have on the debit side. Okay, so why is it debit? Is because the bond investment is assets, and therefore we debit these assets. Okay. All right. That's the first question, the journal entry. The second question, they said, hey, what is the journal entry to recognize the interest revenue and the recognition of the fair value for 2017? So here, let's just see for the rest of the amortization, how it looks like, okay? Like here, the interest received, we know the cash interest is 36,000. That is 300,000 multiplied by 12%. And the interest revenue is the carrying amount, the beginning carrying amount multiplied by the interest market rate, which is 10%. So the amount amortized is the difference between these two. Just remember this amortized amount, we always want to show up as a positive number. So we just take a difference between these two, make sure the difference is positive. Right. And the carry value, what we do is we take this and we subtract the amount amortized. Okay. I have a question. Student asked me, say, how do you know we should subtract, not add? It's because we know at the end of the amortization, this number has to be the face value, which is $300,000. So go from 322,744 to 300,000. The only way is to going down, not going up. Okay. All right. We can just do this again for the rest of a couple of years. Okay. Let's make sure. 10%. $36, and then we have one more year. Okay. Okay. All right. So you can see here 5-year amortizations, and the last period is January 1st, 2022. That's when you receive the last payment. And now we also need to do another journal entry to recognize the interest revenue. And when we're gonna recognize the interest revenue, and for this year, we do have to do it in December 31st, 2017, okay, 2017. So the journal entry we're gonna have were based on this highlighted row. And here you can see on this date, December 31st, we actually didn't really receive the cash, but we know we're gonna receive the cash the day after. So what are we gonna do? We just write as interest receivables, 36,000. debit. We know we're going to receive very soon. So next one, what we're gonna have is the interest revenue. Interest revenue credit. So the last one we're gonna have is the amount which is amortized. Here we're just gonna directly take it out from the debt investment. When you amortize the debt investment here, because we're reducing it, so we're just gonna credit it. So that's a second journal entry to recognize the interest revenue. And next one, we're going to adjust for the fair market value, right? Here, to adjust for the fair market value, we need to know the difference between the fair market value and the book value. So here, I'm gonna put one more value, one more column here, so you can do the comparison side by side. And on 2017, they tell you the fair value is 320,500. So that's how much you have at the end of the 2017. That's how much you have at the beginning of the 2018. And the next one is 309,000, and next one is 3110. Next one is 300. So that's all the information we have. Yeah. So what we're going to do for the end of the year 2017, we have to make adjustment to the fair market value, basically by comparing the difference. So what I'm doing here is I look at this difference. That's just going to be this one minus that one. Okay, so that's what we have. And now, based on this, what we have, we can make a journal entry, right? So the first journal entry we're going to make again on December 31st, 2017. And let's take a look at the, if we're gonna go from carrying amount to fair market value, we have to actually increase our debt investment. So here, to increase, we have to actually debit the amount to the fair value adjustment account, okay? Because when you debit this account, it's the same direction as the normal balance of the investment, so you're increasing the net debt investment. So here, we're going to use a fair value adjustment account. Okay, and we're gonna debit this difference. Okay. Gonna debit. And then to credit, we're going to use unrealized gains and losses. Okay. Gains and losses. Remember here, because we're doing the available for sale, so we should put equity here, and it's the same amount. Okay, so that's the journal entry we're going to make at the end of the year, 2017 for fair value adjustment. So what happened next year? Next year, again, we need to do the journal entry for the interest and for the fair value adjustment. But for the question, they only ask us to do the fair value adjustment. So that's what I'm going to do. Okay, I'm only do the fair value adjustment. Even we do have to do the journal entry for the interest revenues, but the question only asks for fair value adjustment. Okay. So for fair value adjustment and December 31st, 2018, now you can look at the difference is 5921. Okay. However, you cannot just put that number directly into the journal entry because remember the journal entry is captured for the change. The difference what we have here is the ending balance for the fair value adjustment account. And therefore, if you wanted to know what is the change, we have to look at the T account for this fair value adjustment, okay? So here I'm just gonna draw a T account here. Right, fair value adjustment account at the beginning of the year of 2018. So this is fair value adjustment 2018. Okay, 2018. So for this year, the beginning balance from last year is on the debit side. We have 148.81. So that's the beginning balance. Now let's take a look at the ending balance. For the ending balance for this account, based on what we have, we know you have to go from carrying amount 314,921. So give a different number, different color. We have to go this 314,921 to 309. Therefore, you have to actually reduce the amount. Reduce the amount means we need to have a fair value adjustment on the credit side because debt investment normal balance is debit. To reduce debt investment, you have to credit, and therefore this fair value adjustment account has to come in on the credit side. And therefore, we know at the end, you need to have this, and this number has to be on the credit side. So what is the difference? The difference is going to be this number minus that, minus actually. So the only thing you need to have is that and this. Okay. So to get an ending balance of 5921, you need to have a change 7,401 and show up on the credit side. Okay. And this change is what we're going to use for the journal entry. And here we know fair value adjustment account has to be on the credit side. That is the amount coming in based on the T account. And on the debit side, we again use unrealized gains and losses equity account. So this is a conclude our journal entry for fair value adjustment in year 2018, December 31st. Okay. All right, so that's the first question. The first question is about the fair value adjustment for available for sale. And the reason I know is available for sale because question tells you, and it's reflected in the journal entry when you do unrealized gains and losses dash equity. And so let's take a look at the second question. Okay. So the second question we have here is about equity investment. If you look at equity investment here, the company purchased 25% of the equity investment. And therefore, because 25% is larger than 20%, they're going to use the equity method. Here, we're just going to show you exactly how we do the journal entry related to the equity method. Okay, for this question, they said you want to have all related journal entries. Therefore, the first journal entry you should have is on January 1st, 2012. Okay, on January 1st, 2012, bigger, so you can see what happened is you purchase 25% of the stocks and very straightforward journal entry, equity investment, debit, 200, sorry, and cash, 200, sorry. Debit and credit, very straightforward. Okay. So that's the first journal entry. The second journal entry should be the date when the invested company reported the net income. So the date when Parex report net income. So I don't know exactly when it is, but when the invested company reported the net income, that's when you should have the journal entry. Okay, so the journal entry here is going to increase the equity investment. Why? Because I know the company you invested in actually making a profit, and profit means increase your investment. Okay, so here it's going to be 80,000, which is reported that income adjusted by the proportion of the ownership. Okay, so that's give you 20,000. And here what are you going to credit? We call it investment income. Just pay attention where that goes to. Okay, here equity investment goes to the balance sheet. Investment income goes to the income statement. Next one should be the date when the company actually paying out the dividends. When actually Mary receive dividends. Okay, so when the company receive dividends, and first it's very clear they receive the cash, and how much cash they receive? They receive 25% of the total dividends paid out. So that's 5,000. And here we assume because you have a control, and therefore the company you invested is somehow a part of you. And when they pay out the dividends, in many ways actually reduce your investment you have, because you are actually paying out the equity portion. And therefore, we're going to debit cash and credit equity investment. So that's it. And the intuition is if you invest in a company with more than 20% of the ownership, FASB assume you have a significant influence of the company you invested in terms of operating income and the dividends. Therefore, if they're making money and your equity investment is increasing, if they're paying out the dividend, your equity investment is going down because you're actually paying out your own money. And so that's the intuition. All right, bye-bye.